In the next 12 hours, Bitcoin is going to close the worst month it has had in this entire cycle. May 2026. Down from above $80,000 at the start of the month to $74,054 right now. 5 weeks of grinding pain. 9 straight days of Bitcoin ETF outflows totaling $2.8 billion. The largest exit streak since the funds launched. And while everyone is watching the price get crushed, almost nobody is paying attention to the single most important signal that just flashed underneath it. Bitcoin's implied volatility just dropped to a 9-month low. A 9-month low in the middle of what is supposed to be a violent correction. That contradiction, falling prices combined with falling volatility, is one of the rarest and most powerful structural signals this asset produces. It has only happened a handful of times in Bitcoin's entire history, and what came next every single time was a major directional move. Today, I am going to show you exactly what is happening underneath the price, why this monthly close matters more than any single candle this year, the $80 billion bomb strategy just told the market is coming, and the 3 hidden signals that point to where Bitcoin actually goes from here. This is the most important Sunday breakdown I have done all cycle. Do not click off. Let's go. Before we dive in, listen. What I am about to walk you through over the next 40 minutes is the kind of structural analysis that 95% of crypto channels never even attempt because it requires connecting data points that most people would not even know to look at. The people who stick with this channel are the ones who never get blindsided by these moves, who see the structural setups before they resolve, who understand the why and not just the what. So you already know what to do. Now let me show you the most important signal of the entire month that nobody is talking about. Bitcoin's implied volatility just dropped to a 9-month low. Let me explain what implied volatility actually measures and why this matters so much, because I want you to understand the magnitude of this signal at a level beyond the headline. Implied volatility is the market's expectation of how much Bitcoin will move over the next 30 days, derived from options pricing. When options traders are expecting big moves, they pay higher premiums for downside protection, and implied volatility rises. When options traders are not expecting big moves, premiums fall and implied volatility drops. Normally, falling implied volatility happens when prices are stable or slowly rising. Calm markets produce calm pricing. What is happening right now is fundamentally different and historically rare. Bitcoin's price is falling. The fundamentals are challenged. The headlines are bearish. The ETF flows have been negative for 9 straight days, and yet implied volatility is dropping to a 9-month low. That tells you something very specific. It tells you that the options market, which is dominated by sophisticated institutional traders, not retail, is no longer expecting big downside moves. The professional money is positioned for the volatility to compress, not expand. And when volatility compresses to multi-month lows during a correction, the historical pattern that follows is almost always a violent breakout. Volatility compression is the loaded spring. The compressed spring eventually releases, and the release is the move that catches everyone positioned for continued chop completely off guard. Let me give you the price picture as we head into this critical monthly close, because the levels matter more than they ever have. Bitcoin is at $74,054 on this Sunday morning, with the monthly candle set to close in approximately 12 hours. The opening price for May was approximately $80,000. That means as of right now, the monthly candle is showing a roughly 7.5% decline. Now, 7.5% in a month sounds significant, and it is, but here is the perspective that matters. In every previous Bitcoin cycle at this point in the correction, the monthly drawdowns were typically 15 to 25% during the worst months. The fact that Bitcoin lost only 7.5% during what most analysts consider the most macro-challenging month of this year tells you something profound about the structural support underneath this market. The institutional floor has dramatically reduced the magnitude of the corrections compared to every previous cycle. Even the worst months in 2026 look mild compared to the worst months in 2022 or 2018. That is the difference between an institutionalized Bitcoin market and a purely retail-driven Bitcoin market, and that difference is permanent. The key levels on the daily and weekly charts are crystal clear right now. The first major support below current price is the 73,000 zone, where Bitcoin found buyers multiple times last week. Below that, the 52-week closing low at 62,872 would become the critical reference point, a level that has not been tested in over a year. Above current price, the first resistance is the 76,750-day exponential moving average. Above that is the 78,000 zone of recent congestion. Then 80,000 as the psychological battleground, and then 82 to 83,000 as the 200-day moving average wall that has rejected Bitcoin 5 separate times this month. 5 rejections at the same level. Each rejection has carved that resistance into the chart more deeply, and the eventual break of that level, whenever it comes, will be the signal that the cycle low is behind us. Now let me walk you through the strategy bombshell, because this is the story of the entire week and possibly the entire month, and almost nobody outside hardcore Bitcoin Twitter is properly weighting it. On May 29th, Strategy CEO Phong Le publicly hinted that the company is exploring raising over $80 billion in new capital specifically to deploy into Bitcoin purchases. $80 billion. Let me give you the full context for what this number means. Strategy currently holds approximately 820,000 Bitcoin, valued at roughly $60 billion at current prices. Adding $80 billion in fresh capital deployed into Bitcoin would more than double their position. At current prices, $80 billion buys approximately 1,080,000 Bitcoin. The total annual mining issuance after the April 2024 halving is approximately 164,000 Bitcoin per year. That means Strategy's potential capital raise could absorb 6.5 years' worth of all global mining supply in a single buying program. 6.5 years of total global new supply from one company. And that is on top of the existing institutional demand from ETFs, corporate treasuries, sovereign wealth funds, and long-term holders. The supply-demand imbalance that this would create has no historical precedent. But here is the question I know you are asking. Okay, but is this real or just talk? And the honest answer is that Strategy has a 5-year documented track record of saying they will raise capital to buy Bitcoin and then doing exactly that. Every previous public discussion of capital raises has been followed by execution within 1 to 3 quarters. The CEO of a publicly traded company does not float an $80 billion capital raising plan in a public statement unless internal discussions have already advanced to the point where such a raise is being seriously contemplated. The Phong Le hint is the precursor to the formal announcement. Based on historical pattern, the formal announcement is likely to come within the next 30 to 90 days, possibly at the next earnings event or major investor conference. And when that formal announcement hits, the market will react to it as fresh news, even though we got the early heads up right now while Bitcoin is sitting at 74,000. That asymmetry, getting the early hint before the formal announcement, is exactly what gives the patient holders an edge that the panicking retail crowd is missing. Let me also walk you through what Strategy's previous accumulation phases have done to the Bitcoin price, because the historical record is genuinely instructive. In the second half of 2025, Strategy accumulated aggressively while Bitcoin ran from the 70,000 range to its all-time high of 126,000. Their buying did not single-handedly cause that entire move, but it was a significant structural contributor. And that was while they were buying at a pace of a few thousand Bitcoin per quarter. An $80 billion capital raise represents a buying pace exponentially higher than anything Strategy has done before. The price implications, in a market where liquid supply is already constrained and structural demand from multiple sources is growing, are mathematically extraordinary. This is not just additional buying pressure. This is a step change in the magnitude of institutional Bitcoin demand that could fundamentally reset the price discovery range. Now let me give you the second massive structural development from the past week, because it deserves attention that the headlines have not given it. On May 29th, the U.S. Commodity Futures Trading Commission gave Kalshi EX approval to launch the first regulated Bitcoin perpetual futures contract on a major U.S. exchange. The contract is called BTC-PERP. To understand why this matters, you need to understand the global Bitcoin derivatives market. Bitcoin perpetual futures contracts are by far the dominant derivative product in crypto globally. They trade on offshore exchanges like Binance, IBIT, OKX, and BitMEX. The total open interest across these perpetual futures markets is in the tens of billions of dollars. But U.S. institutional investors have been largely restricted from accessing these markets due to regulatory uncertainty. The CFTC approval of Kalshi's perpetual contract is the first opening of regulated perpetual futures access to U.S. institutional players. This brings sophisticated U.S. trading firms, hedge funds, and institutional allocators into a market they were previously locked out of. The depth and sophistication of the U.S. Bitcoin market just expanded dramatically with one regulatory decision. And the new institutional players entering this market all need long Bitcoin exposure to use the futures effectively, which means structural buying pressure as the market develops. These two developments, Strategy's $80 billion plan and the CFTC perpetual futures approval, happened within 24 hours of each other. Both are massively bullish for Bitcoin's institutional infrastructure. Both occurred while Bitcoin sat at 74,000 in extreme fear. And both are being almost entirely buried by the headline focus on ETF outflows and the price action. That asymmetry between what is actually happening structurally and what the headlines focus on is one of the clearest possible signals that you are at an inflection point. The headlines tell you about the past. The structural developments tell you about the future. And the future being built right now is one in which Bitcoin has dramatically more institutional infrastructure, dramatically more corporate demand, and dramatically more regulated derivatives access than it has ever had. Let me now address what is perhaps the single most important on-chain metric to understand right now, because I think CryptoQuant's recent observation about long-term holder supply has been widely misread. CryptoQuant reported this week that Bitcoin's long-term holder supply hit a record high. Wallets that have not moved their coins in over 155 days now hold more Bitcoin than at any point in history. The bullish rate of this data is obvious. Record long-term holder supply means conviction holders are not selling at these prices. CryptoQuant offered a more nuanced interpretation, noting that the record reading could partially reflect a buyer drought where there are not enough new buyers to absorb supply at higher prices, leaving more Bitcoin classified as long-term held than would otherwise be the case. Both interpretations have merit, but here is what I think is the more sophisticated read that most analysts are missing. Long-term holder supply at record highs combined with weak ETF inflows tells you the existing Bitcoin holders are extraordinarily committed to their positions, while the new buyer base has temporarily weakened. That is not a contradiction. That is a setup. It is exactly the kind of structural condition where a small return of new buyer interest produces a violent price response because there is no supply available at current levels to absorb new demand. The existing holders are not selling. The new buyers have stepped away. When the new buyers come back, through a strategy capital raise, through ETF flow reversal, through a macro catalyst, the limited float meets fresh demand and price discovery has to find a new equilibrium quickly. Let me give you the precise framework for the on-chain metrics that the smart money is using right now, because once you understand these metrics, you stop being part of the panicking retail crowd and you start thinking like the people who actually profit from these setups. The first metric is the MVRV Z-score. The market value to realized value Z-score compares Bitcoin's current market price to the average price holders actually paid. When the Z-score is high, holders are sitting on huge profits and the market is overheated. When the Z-score is low, holders are near break-even, and the market is undervalued. The Z-score at the October 2025 all-time high was around 3.8. The Z-score during the early 2023 accumulation phase was below 1. Currently, the Z-score sits in the accumulation zone. Every single 12-month period in Bitcoin's history that began with the Z-score at current levels has produced positive returns. Every single one. The track record across multiple cycles is unbroken. That is not a guarantee about the future, but it is one of the most consistent statistical patterns this asset produces. The second metric is exchange reserves, the total Bitcoin held on centralized exchanges available to be sold. When Bitcoin flows onto exchanges, it usually signals holders preparing to sell. When Bitcoin flows off exchanges into self-custody and cold storage, it signals long-term accumulation. Exchange reserves have been falling steadily for over a year and sit at 7-year lows. Even through this month's correction, with all the ETF outflows and the bearish headlines, the net flow has been off exchanges rather than onto them. That is the supply side of the market quietly tightening at the same time everyone is focused on the demand side. The third metric is realized profit and loss, the dollar value of Bitcoin moving on-chain in profit versus loss. Realized losses have spiked over the past 2 weeks as price has declined, which is consistent with weak hand capitulation. Weak hand capitulation is what creates the supply transfer to strong hands that historically marks cycle bottoms. The fourth metric is funding rates on perpetual futures. Funding rates have been neutral to negative during this entire correction, meaning the market is positioned defensively and there is heavy short exposure that becomes squeeze fuel if the price reverses. All four metrics tell the same story: accumulation, supply tightening, capitulation by weak hands, and structural pessimism that sets up the asymmetric upside. Now let me give you the macro context, because it has been the dominant variable all month, and it will be the dominant variable for what happens next. The April CPI came in at 3.8% year over year. The April PPI came in at 6%. Those inflation readings shifted the Federal Reserve rate expectations from a cutting bias toward a potential hiking bias. Probability of a rate hike by December surged from essentially 0 to nearly 50% during May. Treasury yields rose. The dollar strengthened, and risk assets, including Bitcoin, sold off in response. That macro repricing is the engine of the entire month's decline. But here is the critical context for what could change in the coming weeks. The PCE inflation data, the Federal Reserve's preferred inflation measure, drops in early June. If PCE comes in softer than CPI and PPI suggested, it would moderate the rate hike pressure. The June FOMC meeting, which will be Kevin Warsh's first as Federal Reserve Chair, has the potential to be the most market-moving event of the summer. Trump has publicly pressured Warsh to deliver rate cuts. The political dynamics suggest dovish surprise potential is higher than the market is pricing. If Warsh signals even a modest dovish lean, language suggesting the Fed remains data-dependent rather than pre-committed to tightening, the dollar weakens, yields drop, and the macro headwind on Bitcoin reverses into a tailwind. Let me also discuss the regulatory picture, because it is moving in directions that are extraordinarily bullish for Bitcoin's medium-term outlook. The Clarity Act, which cleared the Senate Banking Committee on May 14th, is on track for a Senate floor vote now that Memorial Day recess has ended. The Senate is back in session and could schedule the floor vote at any point in June. If the bill passes the full Senate, it goes to the House for reconciliation, and the White House has publicly stated a goal of having the bill signed into law by July 4th. The passage of the Clarity Act would represent the most comprehensive federal regulatory framework for digital assets in U.S. history. The institutional capital waiting for that legal clarity is measured in the hundreds of billions of dollars. When the framework is in place and that capital begins deploying, the structural demand picture for Bitcoin changes dramatically. Combine the Clarity Act passage with the CFTC perpetual futures approval, the strategy capital raise, and the SpaceX IPO with its $1 billion Bitcoin position, and you have a four-way catalyst convergence that could fundamentally reset Bitcoin's price discovery in the second half of 2026. Let me address the question I know you are asking. Given all of this structural bullish setup, why is Bitcoin at 74,000 instead of 100,000? Why is the market not pricing in any of these positive developments? And the answer is that markets are weighing machines in the long run and voting machines in the short run. In the short run, the macro environment dominates everything. The inflation prints, the Fed rate expectations, the ETF flows, the geopolitical headlines. Those forces have created a temporary headwind that has overwhelmed the structural bullish setup. But the structural setup does not disappear because the short-term price action is weak. It accumulates. It builds. And when the macro headwind eventually subsides, through a softer PCE print, through a dovish wash statement, through ETF flow reversal, the accumulated structural bullish forces get to express themselves in the price. The question is never whether the structural setup eventually plays out. It always does in markets. The question is the timing, and the timing is impossible to predict precisely. What we can do is identify the specific catalysts that could trigger the resolution, and right now those catalysts are clustered in the coming 4 weeks. The PCE inflation data drops in early June and could moderate rate hike expectations if it comes in soft. The June FOMC meeting is in mid-June and will give Warsh his first opportunity to set policy direction. The Clarity Act could have a Senate floor vote at any point in June. The SpaceX IPO is expected in mid-June and will create one of the largest tech IPO events in history with potential Bitcoin treasury implications. Strategy could formalize its capital raising plans at any point. The ETF outflow streak will eventually exhaust as the tactical selling pressure reaches natural limits. Any one of these catalysts could be the trigger that breaks the loaded spring setup. Multiple catalysts arriving in sequence could produce rapid sequential upside moves that compound quickly. Now let me give you the longer-term structural view, because zooming out is what keeps you grounded during weeks like this one. Bitcoin hit its all-time high of 126,000 in October 2025. We are now 8 months past that peak, sitting at 74,000. That represents a 41% drawdown from the high. In Bitcoin's entire history, every cycle has had a major post-peak correction. The 2017 cycle saw an 84% drawdown over 12 months. The 2021 cycle saw a 76% drawdown over 12 months. This cycle has been limited to a 41% drawdown over 8 months. That is dramatically shallower than any previous cycle at the same point. The reason is the institutionalization of Bitcoin and the structural floor created by ETFs, corporate treasuries, and whale accumulation. The shallower drawdown means the cycle low, when it sets, will be significantly higher relative to the peak than previous cycle lows. Where previous cycles bottomed at 16 to 20% of their peaks, this cycle's bottom is likely to be in the 50 to 60% range based on the structural support demonstrated so far. That math points to a cycle low somewhere between 60,000 and 75,000, with the worst case being a test of the 52-week low at 62,800. The 74,000 price right now is essentially in the cycle low zone by any historical measure. What does that mean practically for you? It means the downside from current prices is mathematically limited to approximately 15% in the absolute worst case scenario. 15% of additional downside risk versus the potential to recover 70% or more to the previous all-time high. That asymmetric risk reward is what the smart money is reading. It is what the whales are positioning for. It is what strategy is preparing to deploy $80 billion to capture. And it is hidden in plain sight underneath the noise of the ETF outflow headlines and the extreme fear sentiment readings